Hello everyone, and welcome back to the channel. Today, we're diving straight into the heart of global finance, specifically the recent pivotal announcement from the Bank of Japan that's sending ripples across markets worldwide. If you're tracking the pulse of the economy or just curious about what keeps central bankers up at night, this is a discussion you won't want to miss. We're going to break down exactly what the BOJ decided, why it matters, and what it could mean for your investments and the broader economic landscape. On Tuesday, the Bank of Japan delivered a highly anticipated update, opting to keep its benchmark interest rate unchanged at 0.5%. This move was largely in line with market expectations, signaling a continued effort to maintain economic stability amidst persistent global uncertainties. However, the more significant announcement, and perhaps the one causing the most discussion, was the BOJ's plan to gradually slow the reduction of its Japanese government bond, or JGB, purchases starting in April 2026. This isn't a sudden shift, but rather a modification to an existing strategy. For context, the BOJ has already been steadily reducing its JGB purchases by approximately 400 billion yen per calendar quarter, a pace it intends to maintain through March 2026. After that, from April 2026 to March 2027, the pace of these quarterly reductions will effectively be halved to about 200 billion yen, with the ultimate goal of bringing monthly JGB purchases down to around 2 trillion yen by early 2027. To put this in perspective, for the current quarter ending June 2025, the monthly JGB purchase amount is estimated to be around 4.1 trillion yen. This cautious approach to slowing quantitative tightening reflects the central bank's deliberate effort to manage market expectations and enhance the functioning of the JGB markets in a way that supports stability. Governor Kazuo Ueda emphasized that this measure is designed to avoid abnormal volatility in government bond yields, which could have a negative impact on the Japanese economy. The BOJ aims to reduce its JGB purchases in a predictable manner while retaining flexibility to adapt to any sudden market changes. Given that the BOJ's existing JGB holdings are heavily concentrated in long-term maturities, a slower pace of quantitative tightening is anticipated to have a more pronounced impact on long-term market rates rather than immediate effects on the policy rate itself. It's also important to note that the BOJ views balance sheet reduction as distinct from its policy rate decisions, meaning a slower taper doesn't automatically imply a slowdown in future rate hikes. Japan's economy is navigating a complex environment, characterized by growth uncertainties, even as inflation stubbornly remains above the central bank's 2% target. Recent data revealed that Japan's gross domestic product, or GDP, contracted by 0.2% in the first quarter of 2025, primarily due to weaker exports, marking the first quarter-on-quarter contraction in a year. The BOJ expects economic growth to moderate, citing a slowdown in overseas economies and a decline in domestic corporate profits, influenced by global trade weaknesses. Against this backdrop, the central bank believes that maintaining accommodative financial conditions will be crucial in supporting the economy. Inflation, at 3.6% in April, has continued to exceed the BOJ's target for about 3 years, partly driven by factors like a shortage of rice, which even led the government to release emergency stockpiles. While these inflationary pressures are broadening into services and other manufactured goods, and rents are expected to pick up, Governor Ueda has maintained that further rate hikes are still on the table once there's greater conviction that underlying inflation will consistently approach or remain near the 2% target. A significant shadow hanging over the BOJ's decision-making is the ongoing uncertainty stemming from U.S. trade policy. Analysts have frequently highlighted that the trade disputes, particularly those initiated by U.S. President Donald Trump, are influencing the BOJ's cautious stance on further rate hikes. Japan, a vital U.S. ally and investor, is already subject to baseline tariffs, with additional levies on specific goods like cars, steel, and aluminum. While an announced 24% reciprocal tariff on Japan was later paused, the threat of these measures continues to weigh on sentiment. Recent discussions between Japanese Prime Minister Shigeru Ishiba and President Trump on the sidelines
deadlines of the G7 summit reportedly did not yield a breakthrough on a trade deal. Governor Ueda has stated that policymakers are closely monitoring the economic impact of various trade policies, noting that they could become more pronounced, potentially affecting corporate earnings, especially for manufacturers, and consequently impacting wages and prices in Japan. This suggests that the BOJ may indeed hold off on further rate increases until more clarity emerges regarding U.S. trade policy. Financial analysts are weighing in on the BOJ's strategic choices. HSBC Global Research, for instance, views the 2 trillion yen monthly purchase target as a natural level, aligning it with bond purchase amounts seen before Japan's ultra-loose monetary policy was adopted in 2013. Krishna Bhimavarapuf, an OPAC economist at State Street Global Advisors, described the BOJ's decision to delay slowing purchases until 2026 as a minor victory, suggesting that the market doesn't currently require urgent intervention despite recent surges in long-term yields. However, some analysts, like those at ING, interpret Governor Ueda's recent remarks as leaning towards a more dovish stance, particularly given his concerns about tariffs impacting future wages and winter bonuses. ING now predicts that a rate hike in the third quarter of this year is unlikely, with a possible delay until early 2026, unless a U.S.-Japan tariff agreement is reached or significant underlying inflationary pressures emerge in the fourth quarter of this year. Conversely, Katsutoshi Inadome of Sumi Trust still anticipates a rate hike in the second half of the year, based on the BOJ's commitment to normalizing monetary policy and expectations of solid domestic demand and improving economic conditions. Carol Kong from the Commonwealth Bank of Australia also believes the BOJ will likely defer rate hikes until U.S. trade policy becomes cleared, questioning whether domestic demand can withstand additional tightening. The market reaction to the BOJ's decision has been nuanced. Ahead of the announcement, the Japanese yen generally weakened against the U.S. dollar, but saw a slight recovery immediately afterward. Following the decision, the Nikkei 225 stock index gained, the yen strengthened modestly, and the 10-year JGB yield climbed. Experts anticipate that Japanese equity exchange-traded funds such as the iShares currency-hedged MSCI Japan ETF, Wisdom Tree Japan Hedged Equity Fund, and JP Morgan Beta Builders Japan ETF are likely to benefit from this somewhat dovish move by the BOJ. Conversely, currency-focused ETFs like the Invesco Currency Shares Japanese Yen Trust might experience a decline in strength. The cautious stance on bond tapering is particularly impactful on the long end of the yield curve, as the BOJ's holdings are concentrated in long-term maturities. Ultimately, the Bank of Japan is navigating a delicate balance, managing persistent inflation and global trade uncertainties while supporting economic growth. Their decision to slow the pace of bond purchase reductions rather than halting them abruptly reflects a strategic effort to maintain stability and avoid market disruptions. The path forward remains subject to shifts in global trade dynamics and Japan's domestic economic performance. But for now, the BOJ appears committed to a measured, flexible approach. Thank you for tuning in to this important market update. If you found this information valuable, please consider giving this video a like and subscribing to the channel for more financial insights. Your support helps us bring you more in-depth content. We'll see you in the next video.